I want you to pull up your insurance policy right now. Look at the company name printed at the top. That name, that logo, that company you trust to pay your medical bills. The company you trust to rebuild your house after a fire. The company you trust to take care of your family when you die. That company is buying silver, not stocks, not treasury bonds, physical silver. Bars stored in vaults, allocated to their balance sheet, and they are not telling you about it. This is not speculation. This is filed. This is documented. This is buried in subsidiary structures and offshore allocation reports that nobody reads. But I read them, and what I found should change the way you think about money, about insurance, and about what the smartest financial minds in the world are quietly preparing for. Over the last 18 months, the global insurance industry has accumulated approximately $12 billion in physical silver exposure. That number did not come from a press release. It came from cross-referencing COMEX delivery reports with European regulatory filings with Asian custodial records. It came from connecting dots that were deliberately scattered across 3 continents. Someone does not want you to see the full picture. But today we are going to see it anyway. If you work in the insurance industry, you are probably nervous right now. You are wondering what your employer knows that you do not. You are wondering why your risk committee has been meeting behind closed doors. You are wondering if the company you work for is preparing for something they cannot say out loud. If you are a silver stacker, a physical metal holder, you are feeling something different. You are feeling validated. You always knew the institutions would come. You always knew that eventually the big money would figure out what you figured out years ago. That paper is just paper. That promises are just promises. That only metal is money. But if you are a regular person with a life insurance policy and a retirement account and a general sense that the system will keep working because it has always worked, you need to pay very close attention to what I am about to show you, because the most conservative investors in the world are making a move that contradicts everything they are supposed to believe. And when insurance companies contradict their own DNA, it is not a mistake, it is a signal. Let me tell you what makes this so significant. Insurance companies are boring by design. They are legally required to be boring. Regulators force them to hold safe assets, treasury bonds, municipal debt, investment-grade corporate paper. They are not allowed to speculate. They are not allowed to gamble. Their entire business model is based on being the most predictable, most stable, most conservative capital allocators on the planet. They calculate risk down to the decimal point. They employ thousands of actuaries whose entire job is to ensure that the company can pay its obligations 30, 40, 50 years into the future. So when these companies start accumulating a volatile, historically manipulated, relatively small precious metal, it is not because they want to get rich. Insurance companies do not think that way. It is because they have seen something in their models, something in the data, something in the actuarial projections that terrifies them. And the only asset they trust to survive what they see coming is silver. This is not gold. Gold would make sense. Gold is the traditional safe haven. Gold is what central banks hold, but silver is different. Silver is smaller. Silver is more volatile. Silver is more industrial. The fact that they chose silver tells us something important about what they expect. They are not just hedging against inflation. They are not just hedging against a market crash. They are hedging against a complete repricing of monetary assets. They are positioning for a world where the metals that make modern technology possible become more valuable than the paper that governments print. In this investigation, we are going to pull back the curtain on the $12 billion accumulation. We are going to trace the money from the insurance company headquarters to the bullion bank vaults to the COMEX warehouses. We are going to explain why actuaries, the most risk-averse mathematicians in finance, are suddenly demanding exposure to a metal that can move 10% in a single day. We are going to decode the internal risk committee language that reveals what they actually think is coming. And we are going to show you why the physical silver market is tightening at the exact moment when industrial demand is exploding. By the end of this breakdown, you will understand something that 99% of investors do not understand. You will understand why the people who professionally calculate catastrophic risk are betting on silver. And you will have to decide whether you trust their models or whether you think they are wrong. But here is what I can tell you. Insurance companies are not wrong very often. Their survival depends on being right. And right now, they are saying something very clearly with their money. They are saying that the system is fragile. They are saying that paper is dangerous. They are saying that $12 billion in silver is not enough. Let us start with how we found them. The first clue appeared in Luxembourg. 3 months ago, a filing hit the Luxembourg Financial Registry. It was routine, a subsidiary restructuring, the kind of document that lawyers produce and nobody reads. But buried on page 47, in a section titled Alternative Asset Allocations, there was a single line. The subsidiary had allocated $2.3 billion to non-sovereign monetary instruments. That is corporate legal language. It is designed to be boring. It is designed to make your eyes glaze over. But when you know what to look for, that phrase lights up like a flare. Non-sovereign monetary instruments. That means assets that are money, but not government money. That means gold. That means silver. That means physical metal sitting in a vault with your name on it. A $2.3 billion allocation from a single subsidiary of a single insurance company. And when I pulled the COMEX delivery reports for the same quarter, the math did not add up. The physical deliveries were 3 times larger than the filing suggested. Someone was using shell structures, layered subsidiaries, offshore custodians to hide the true size of their position. They did not want the market to know. They did not want their competitors to know. They definitely did not want you to know. Let me tell you who we are talking about without telling you the names, because the lawyers would feast on this video if I name names without ironclad documentation, but I can tell you the profiles. Company A is a European reinsurer, not an insurance company, a reinsurer. That means they insure the insurance companies. They are the backstop behind the backstop. They have over $400 billion in assets under management. They have been in business for more than 150 years. They survived 2 world wars. They survived hyperinflation in the 1920s. They survived the 2008 financial crisis. They survived COVID. When a company like that changes its asset allocation, it is not a trend-following move. It is not a speculation. It is a calculated response to a risk they have modeled and quantified and determined to be unacceptable. Company B is an American life insurance giant, household name. The kind of company that sponsors golf tournaments and runs commercials during the Super Bowl. They manage retirement assets for millions of Americans, pensions, annuities, 401k rollovers. They have a fiduciary duty to protect that money. And starting in late 2023, they began quietly adding silver exposure through a Cayman Islands subsidiary that holds allocated metal in Swiss vaults. The position does not appear on their main balance sheet. It appears 3 levels down in a structure that most analysts never examine. But the metal is there. The custodial receipts are filed. The silver is real. Company C is Asian, a conglomerate based in a country that has been accumulating gold at the sovereign level for years. Their insurance subsidiary has been even more aggressive than the Western players. They are not just buying silver, they are buying silver miners. They are securing streaming agreements. They are locking up future production. They are playing the long game in a way that Western companies are only starting to understand. Now let me explain the mechanism. How does an insurance company actually buy $12 billion in silver? They cannot just call a coin dealer. They cannot walk into a bullion shop and say, give me 10 million ounces. They operate through institutional channels, allocated accounts at bullion banks, ETF creation units, COMEX futures contracts that they actually stand for delivery on. That last part is critical. Most futures traders never take delivery. They buy a contract. They sell a contract. They make or lose money on the price movement. The metal never moves. It is just a betting slip. But the insurance companies are different. They are demanding delivery. They are saying, we do not want the paper contract. We want the bars. We want them allocated. We want them in a vault with our name on them. We want to be able to audit them. This is a fundamental shift in how institutional money interacts with the silver market. For decades, the paper market controlled the price. Banks could sell unlimited paper contracts to suppress the price because nobody ever called their bluff. Nobody ever said, show me the metal. The insurance companies are saying, show me the metal. And the metal is running out. I spoke to a source inside a major bullion bank. He would not go on record. He would not even let me record the call. But he told me something that I keep turning over in my mind. He said the insurance flows are different. He said when a hedge fund buys silver, they buy it fast and they sell it fast. They are tourists. But the insurance money is patient. It accumulates slowly. It never sells. It just sits there, absorbing supply. He said we used to be able to manage these flows. We used to be able to source metal when we needed it. Now he said we are making phone calls we have never had to make before. We are asking miners to accelerate shipments. We are paying premiums we have never paid. He said the insurance companies broke something. They broke the assumption that there would always be enough metal to go around. There is one more piece of the puzzle, the regulatory loophole that makes this possible. Insurance companies are required to hold safe assets against their liabilities. For a century, safe meant government bonds. But after 2008, after the European debt crisis, after inflation came roaring back, the regulators had to adapt. Under certain frameworks, physical metal held in allocated accounts at systemically important banks can qualify as Tier 2 capital equivalent. It is not quite as good as government bonds for regulatory purposes, but it counts. It satisfies the requirements. The insurance companies found a way to hold real money, ancient money, metal that has been money for 5,000 years, and still check the regulatory boxes. They are playing within the rules. They are just playing a game that nobody expected them to play. So we know who is buying. We know how they are buying. We know the structures they are using. We know the custodians they are trusting. But we still have not answered the most important question. Why? What do the actuaries see? What risk are they modeling? What scenario keeps them awake at night? The answer lies in a single concept that most investors have never heard of, a concept called duration. And once you understand duration, you will understand why $12 billion is just the beginning. Let me explain duration in a way that will change how you see the entire financial system. Imagine you lend your neighbor $1,000 for 30 years. He agrees to pay you 3% interest every year. That is $30 annually. Sounds reasonable? Sounds safe? You shake hands. The deal is done. Now fast forward 5 years. Inflation is running at 7%. The groceries that cost you $100 when you made that loan now cost $140. But your neighbor is still paying you $30. The same $30. That $30 now buys what $21 used to buy. You are getting poorer every single year while technically receiving income. By year 30, that $30 payment will buy what $8 bought when you started. You did not lose money on paper. You lost money in reality. You were robbed in slow motion by a force you could not see and could not stop. That is duration risk, and that is exactly what is happening to the insurance industry right now. The average life insurance company holds assets with a duration of 15 to 20 years. Some hold bonds that mature in 30 years. They bought these bonds when interest rates were low because regulators told them to. They bought these bonds because they were safe. Government guaranteed, AAA rated, the bedrock of conservative portfolio management. But those bonds are now underwater. A bond portfolio worth $100 billion in 2020 might have a market value of $75 billion today. The loss is real. The loss is on the books, but it gets worse. The liabilities did not shrink. The insurance company still owes death benefits, still owes annuity payments, still owes pension obligations. Those obligations are fixed in nominal dollars. The assets melted. The liabilities stayed frozen. This is a solvency crisis hiding in plain sight. I spoke to a retired actuary from one of the largest life insurers in America. He spent 30 years building risk models. He would not let me use his name. But he said something that I have not been able to stop thinking about. He said our models are broken. He said we stress test for inflation. We stress test for deflation. We stress test for market crashes and pandemics and natural disasters. But we never stress tested for a currency crisis in a reserve currency. We never modeled what happens if the dollar itself becomes unstable. He said 2020 changed everything. The amount of money they printed, the speed at which they printed it, the casual way they added trillions to the balance sheet. He said we had to start modeling the unthinkable. And when you model the unthinkable, you need assets that exist outside the system you are modeling against. That is where silver enters the equation. But why silver specifically? Why not just gold? Gold is the traditional hedge. Gold is what central banks hold. Gold is the senior monetary metal. The answer reveals how sophisticated these insurance companies actually are. First, silver is smaller. The entire silver market is worth a fraction of the gold market. A $12 billion position in gold barely moves the needle. A $12 billion position in silver is transformational. It gives them leverage. It gives them asymmetric upside. Second, silver has industrial demand. Solar panels, electric vehicles, electronics, medical devices. If the monetary thesis somehow fails, if the currency crisis never comes, they still own a metal that civilization cannot function without. It is a hedge with a backup thesis. Third, and this is the part that tells you how serious they are, silver is more volatile. Insurance companies hate volatility. Their entire business is about smoothing out volatility. So why would they buy a volatile asset? Because they want the convexity. They want the explosive upside. They have calculated that in the scenario they are hedging against, silver does not just go up 50%. It goes up 500%. They are buying a lottery ticket that they think has very good odds. There is a memo that has been circulating among risk professionals. I cannot share the document. I cannot even confirm which company produced it, but I can share the language because the language tells you everything. The memo recommends increasing allocations to non-sovereign monetary assets to offset tail risk in fiat duration exposure. Read that again. Non-sovereign monetary assets. Assets that are not controlled by governments. Tail risk. The risk of extreme events. Fiat duration exposure. The risk that paper money loses value over time. This is a 150-year-old company putting in writing that they do not trust the system. They are not saying it publicly. They are not telling their policyholders. But internally, in the documents that guide actual capital allocation, they are saying the quiet part out loud. The duration crisis is not a future problem. It is a current problem. It is on the balance sheets right now. It is in the mark-to-market losses that companies are praying they never have to realize. And the only solution that the actuaries trust is the same solution that humans have trusted for 5,000 years. Metal. Real metal. In a vault. With your name on it. No counterparty. No duration. No government that can print more of it. The insurance companies are not speculating. They are surviving. And their survival instinct is telling them that $12 billion is not nearly enough. Now we need to talk about what $12 billion does to a market, because this is not abstract. This is not theoretical. This is physical metal leaving the system and never coming back. And the system was not built to handle that. Imagine the silver market is a swimming pool. For decades, the pool has been adequate. Miners produce silver and dump it into the pool. Jewelers scoop some out. Industrial users scoop some out. Investors scoop some out. The water level fluctuates, but it never drains. There's always enough for everyone. The system works. Now imagine a whale enters the pool, not a whale that splashes around and leaves, a whale that drinks, a whale that swallows $12 billion worth of water and then just sits there, absorbing, never giving back. Suddenly the pool is shallower. Suddenly the other swimmers are bumping into each other. Suddenly there is not enough water for everyone. That is what the insurance accumulation has done to the silver market. It has introduced a permanent demand that does not trade. It does not flip. It does not take profits. It just accumulates and holds and waits. Let me give you the numbers that matter. The COMEX is the primary silver futures exchange. It is where the paper price is set. The COMEX has two categories of silver. Registered silver is metal that is available for delivery. It has been certified. It is sitting in approved vaults. If you hold a futures contract and you want physical metal, this is where it comes from. Eligible silver is metal that is in the vaults but not available for delivery. It belongs to someone else. It is just being stored there. Right now, the registered silver at COMEX is approximately 280 million ounces. At current prices, that is roughly $8.4 billion worth of metal. Do you see the problem? The insurance industry has accumulated $12 billion. They have already accumulated more silver than exists in the registered category. They drank the pool and they are still thirsty. Where did the metal come from? It came from the eligible category. Metal that was supposed to be someone else's but got sold anyway. It came from ETF redemptions, shares being liquidated, and the underlying metal being shipped out. It came from miners selling forward production, metal that has not even been dug out of the ground yet. It came from desperate sourcing at premium prices. Every single ounce the insurance companies took had to come from somewhere, and the somewhere is running dry. This is why the premiums are exploding. Go to any major bullion dealer right now. Try to buy 1,000 ounces of silver for immediate delivery. Look at the premium over the spot price. It is 10%. It is 15%. In a normal functioning market, premiums are 3% to 5%. The premium is the market telling you the truth that the spot price is hiding. The physical price is higher than the paper price. The street price is higher than the screen price. And the gap is widening because the paper market is a fiction and the physical market is reality. The insurance companies figured this out. That is why they are taking delivery instead of holding paper contracts. They are front-running the disconnect. The bullion banks are in trouble. They have operated for decades on a fractional reserve basis. They sold more silver than they had because they knew that most buyers would never ask for delivery. It was just paper shuffling back and forth, numbers on a screen. Nobody wanted the metal. They wanted the price exposure. But the insurance companies want the metal. They are standing for delivery. They are saying, show me the bars, and the bullion banks cannot say no. They cannot default on a reinsurer. They cannot tell a $400 billion insurance company that the metal does not exist. So they scramble. They lease from ETFs. They call miners begging for accelerated shipments. They pay premiums they have never paid before. And every single delivery tightens the vice. Every ounce that leaves the system is an ounce that cannot be used to settle the next contract. Here is the paradox that confuses most investors. If there is a shortage, why is the price not higher? The answer is the paper market. The COMEX allows banks to sell unlimited paper contracts without holding the underlying metal. They can create artificial supply out of thin air. This suppresses the price. It has worked for decades, but it only works as long as nobody calls the bluff. The insurance companies are calling the bluff. They are buying the paper and then demanding the metal. Every delivery forces the banks to find real silver. And real silver is not infinite. When the deliveries exceed the available supply, when a major contract fails to deliver, the paper price will snap to the physical price. It will not be a gradual rise, it will be a gap. A violent repricing. The insurance companies will be sitting on a mountain of metal bought at $30, and everyone else will be fighting over scraps at $100. Here is what took me months to understand. The insurance companies are not just hedging against inflation. They are not just hedging against a silver shortage. They are not even hedging against a market crash. They are hedging against the collapse of the counterparty system itself. And once you understand what that means, you will never look at your portfolio the same way again. Every financial asset you own is someone else's liability. Think about that. Your bank deposit is the bank's liability. They owe you that money. Your government bond is the government's liability. They owe you that money. Your corporate stock is a claim on a company's assets, assets that are themselves financed by debt that someone else owes. The entire financial system is a web of promises, IOUs stacked on top of IOUs. And every single one of those promises depends on the counterparty being able to pay. If the counterparty fails, your asset evaporates. It does not decline in value. It ceases to exist. But silver in a vault is different. Silver is not a promise. Silver is not a claim. Silver is not dependent on anyone else's ability to pay. It just exists. It has existed for 5,000 years. It will exist for 5,000 more. When an insurance company puts silver in a vault with their name on it, they are removing that capital from the counterparty web. They are saying, we do not care what happens to the banks. We do not care what happens to the government bond market. We do not care what happens to the clearing system. This metal is ours. It cannot default. It cannot be frozen. It cannot be bailed in. It is the only financial asset that is simultaneously no one else's debt. Think back to 2008. The insurance giant AIG nearly destroyed the entire global financial system. They had sold trillions of dollars in credit default swaps, insurance against bonds defaulting. When the bonds defaulted, AIG could not pay. They were the counterparty, and the counterparty failed. The government had to step in with $180 billion to prevent a cascade that would have taken down every major bank in America. That was a counterparty crisis contained by a government bailout. But ask yourself the next question. What happens when the counterparty that fails is the government itself? What happens when the entity that bailed out AIG needs a bailout? Who bails out the bailer? There is no answer. There is no entity large enough. There is no mechanism. There is only chaos. And the insurance industry has modeled this scenario. They have stress tested it. They have run the numbers, and their answer is silver. This is not just an American phenomenon. Look at what is happening globally. China has been accumulating gold at the sovereign level for over a decade. Russia converted a massive portion of its reserves into gold before the sanctions hit. The BRICS nations are openly discussing a commodity-backed trade settlement currency. The central banks of the world are buying more gold than at any point in the last 50 years. The insurance companies see this. They read the same reports, but they also have access to information that retail investors do not have. They have relationships with central bankers. They have consultants who brief them on geopolitical risk. They know that the dollar's reserve currency status is not guaranteed. They know that the monetary system that has existed since 1971 is showing cracks, and they are positioning for what comes after. Here's where it gets personal. Many of these insurance companies manage pension funds. They have a fiduciary duty to protect retirement assets. When a pension fund adds silver exposure, it is not speculation. It is a legal obligation being fulfilled. The fiduciaries looked at the traditional portfolio of stocks and bonds and determined that it is not sufficient. They determined that real assets are necessary for survival. Think about your own retirement. Is it in a 401k? Is it in a target date fund? Is it in the same portfolio that these sophisticated institutions are quietly abandoning? The insurance industry manages trillions of dollars in retirement assets, and they are telling you with their actions that the old model is broken. What strikes me most about this story is the silence. These companies are not holding press conferences. They are not issuing reports titled, "Why We Are Buying Silver." They are accumulating quietly through structures designed to avoid attention. They do not want to start a panic. They do not want retail investors to front-run them and drive up prices before they finish accumulating. They do not want to explain to regulators why they are deviating from 100 years of conservative practice. They want to finish their positioning before anyone notices. But the filings are there. The delivery data is there. The custody receipts are there. The evidence exists for anyone willing to look. Before I tell you what to do, I need to reset the way you are thinking about this. You are not too late. I know it feels like the institutions have a head start. They do. They have been accumulating for 18 months while most people were watching Netflix. But the silver market is tiny. Even after $12 billion in insurance accumulation, silver represents a fraction of global financial assets. The entire market could be purchased for less than the annual revenue of a single large tech company. There is still room. There is still time. But you have to stop thinking like a trader and start thinking like an institution. You have to think in decades, not days. You have to accumulate quietly and hold patiently. You have to become unshakable. Here is what you need to do. First, Assess your own counterparty risk. Look at every financial asset you own. Ask yourself, who owes me this money? If the answer is a bank, a government, a corporation, a brokerage, you have counterparty risk. That does not mean sell everything tomorrow. It means understand what you actually own. Understand that your wealth exists as an entry in someone else's database. And consider whether some portion of your assets should exist outside that database entirely. Second, start with physical metal. Do not start with ETFs. Do not start with futures. Do not start with mining stocks. Start with metal you can hold in your hand. Buy a few ounces. Feel the weight. Understand viscerally what real money feels like. This is not about getting rich. This is about understanding. Once you hold physical silver, the paper market will never look the same to you. You will see it for what it is, a simulation of something real. Third, ignore the price. The insurance companies are not buying silver because they think it will be $35 next month. They are buying because they believe it will be essential in 10 years. They are buying because their actuaries have modeled scenarios where silver is the only asset that survives. Match your time horizon to theirs. If you are checking the price every day, if a $2 drop makes you nervous, you are doing it wrong. You are thinking like a trader when you should be thinking like an institution. The institutions do not care about daily volatility. They care about 30-year solvency. Adopt their mindset. Fourth, diversify your storage. Do not put all your metal in one location. Some at home in a safe you control. Some in a private vault outside the banking system. Some in a different jurisdiction entirely if possible. The insurance companies use multiple custodians across multiple countries for a reason. They are not just hedging against market risk. They are hedging against political risk, against confiscation risk, against the risk that any single government does something desperate. Concentration is a risk. Spread your metal like the professionals do. Fifth, keep learning. This video is a starting point, not an end point. Read the COMEX delivery reports each month, follow the warehouse stock data, watch what the institutions do rather than what they say. The information is public. It is just scattered. It requires effort to compile. But that effort is the edge. Most people will not do the work. Most people will wait for the mainstream media to explain what is happening. By then it will be too late. The insurance companies understand this. They are doing the work now. They are positioning now, they are accumulating now, and they are doing it quietly because they know that the first ones to understand a paradigm shift are the ones who benefit most. The $12 billion hedge is not a conspiracy. It is a filing. It is a delivery report. It is an actuarial calculation made by the most sophisticated risk managers in the world. They are not predicting a crisis, they are preparing for one. There is a difference. A prediction is a guess. A preparation is an action. And 12 billion worth of action tells you everything you need to know about what the smart money believes is coming. The insurance giants are hoarding silver. Now you know why. The only question left is what you will do with this information.